I'm Sebastian St. James. What are margin loans? Good question. And how can I earn $135,795? I'll let you know in a minute. First of all, what is a margin loan, and particularly, what is a margin? Here before you is a margin. There is a top margin, there is a bottom margin. Okay, stop. That's a book margin, and what are you getting at? A margin is a degree of safety. Go on. Margin loans use gearing. What is gearing? Here are some gears. Oh, very good. Yes, like in a car, right? Gearing allows something small to turn something big. Arguably allows something big to turn something small as well. But go on. Margin loans use leverage. But what is leverage? Here is a lever. Okay, so this is like a seesaw. Yeah, I know this. Levers allow you to move a large amount by using a small amount. Enough with these cryptic clues. Yes, levers, gears. A margin loan allows you to use a small amount of your own capital to buy something much bigger. Much bigger, much bigger. And that's a margin loan. In margin loans, you will find these three terms: margins, gearing, leverage. And they all basically mean the same thing. A margin loan magnifies your capital. Good, got the basics, but why am I going to need a margin loan anyway? Here's a table I put together. Imagine you started off with $30,000 there in the top left. The growth of this stock market is going to be 10%. That's pretty good. On the left column, you will find out how much you will earn at 10% return if you use your own money. In year one, we start off at $30,000. In year two, $33,000, right up to the 10th year when there is $70,738. Not bad. That's a good return. Subtract your original $30,000, which leaves you with $40,738 in profit. So I've more than doubled my money. This is exciting. Who needs margin loans? Well, perhaps you do. What would your returns look like if you took a margin loan? Let's look at the right-hand column. You start off with $30,000 of your own. The bank gives you $70,000, which gives you a total of $100,000 in year one. In year two, that's $110,000. In year 10, that is $235,795. Wow, that is so much better than the other system. So we're comparing $70,000 to $235,000, a much, much better return simply by using a margin loan. Okay, now we do have some costs we've got to take out of this. In both cases, we'll take out the initial $30,000 that you put in because we're calculating profit here. Plus, you've got to take out the $70,000 if that was given to you by the bank to start with. So the net profit is $40,738 versus $135,795. That's so much more. So would I like to earn $135,000 in profit or 40? 135, 40. Margin loans can magnify your gains amazingly. I mean, 40,000 in profit, double that is 80,000. Again is 120,000, and I've made more than that, more than 3 times as much just by having a margin loan. But you need to know about LVR. What is LVR? LVR stands for loan to value ratio. If I have $40 and you allow me to borrow another $40, what is my LVR? Fortunately, using grade 3 math, we can find the answer. The total value will be those figures added together, which is $80. LVR is the loan amount, which is $40, divided by the total, which is $80, which is 50%. Sounds intuitive. If I put in $40, the bank puts in $40, the LVR is 50%. Yeah, I understand that. Let's mix it up. If the loan is $60, I put in 20, the total value therefore is 80. The LVR, loan to value ratio, $60 divided by 80, which is 75%. Pretty basic, huh? LVR is simply when you purchase something, what percentage of that money is the bank's? Hang on, is that not like buying a house? Like if I buy a house and put down, say, 20% deposit, has that got anything to do with LVR? Well, yes, it does. You put down 20% deposit, that means you're putting down $80,000. The loan is 40 minus 80, which is $320K you're borrowing. The LVR is 80%, and I put down 20% deposit. This is making sense. This sounds really good. Can I just borrow 100%, yeah? No, you can't. Not on a margin loan anyway. Definitely not. you need to put in some of the capital. But how much? Banks have a maximum LVR depending on how safe they think those assets are. So if you're going to invest in individual specific shares, then the LVR may be a bit lower. If you're going to do it in an ETF, the LVR can be higher. Typically, the maximum LVR is 70%. Now, it does depend on which bank or which lending institution you're using, but 70% is a typical. That means if you put down $30,000 of your own, you can borrow $100,000. Huh. Not bad. Okay, so I go to my bank and get out a margin loan and then I can spend it on whatever shares I want. This is a lovely system. Sign me up, buy some penny stocks. Imagine how much money I'm going to make when they go through the roof. I can hardly wait. Well, no, hold your horses. Hold every single one of them because banks have an approved list upon which only you can borrow. You can't be willy-nilly. You don't get to choose. Well, you do. But you get to choose from their list of shares, which is typically ETFs, mutual funds, and some of your large caps. So no penny stocks for you. Okay, so an approved list of shares. I'll agree to that. And free money from the bank? No, not free money from the bank. When did the bank ever give something free to you? Well, they do charge interest rates, so you have to factor that in. Previously, I gave you a table showing exactly how much you can earn using a margin loan, but now we discover you also have to pay interest costs. Ugh, typically annoying. Let's redo the table. The table is the same, but now it has 5% interest going down the right-hand side, which is $35,000 over that time period. So we earned $235,795, but this time minus $35K, which we've got to pay in interest, which gives me $100,795. The truth here is comparing $40,000 to $100,000. Yeah, in that case, a margin loan is still definitely worth it. Okay, so a risk-free way of more than doubling my profit. I can hardly wait. Where do I sign up? Well, you could double your profit, but it is not risk-free. Here is the same table again. Instead of a 10% year after year, we're assuming that the market is going down for a while by 5%. Only 5. If I'm using just my own money, I start off with $30,000. In year 2, $28,500. Year 3, $27,000. Okay, I am noticing that the amount is going down each year. And in year 10, it's $18,907. So I start off with $30,000. I'm down to $18,000. That's a bit of a drop. But okay, I haven't been wiped out. I can certainly bounce back from that without any problems. On the other hand, if I put in $30,000 of my own, $70,000 I am borrowing for a total of $100,000. In year 2, I am down to $95,000. Yep, that's not bad. And by year 10, I'm down to $63,000. So if I don't borrow, I've made $18,000. If I do borrow, I made $63,000. Sign me up. I'm still liking the odds of this. But you have to deduct your fees. So minus $70,000, which is what the bank gave you in the first place. Okay, this is not good. I've made $63,000. I've got to give back $70,000. I'm already in the red. Plus, there are fees. That's right, you have to pay back your $35K in interest minus the $30,000 which you originally put into the system, which means your profit is minus $71,975. Oh! Okay. That one hurts. If I use my own money, the amount that I would lose in a down market was $11,000. Yeah, okay. However, if I used a margin loan, the amount I lost was $71,975. Whoa! No, too big a difference. Margin loans are dangerous in down markets. That table proves it. Besides avoiding down markets, sure, that's easy to do, are there any more risks? Well, yes, there are. Imagine that you buy a house, you get the keys, and then the market price tanks for your house. Is the bank going to knock on your door and say, I want your house back? Well, no, typically not. Although they do write in sneaky little clauses that allow them to do that sort of thing sometimes. But do you know what? In a margin loan, yes, they will. Let's say the share price is $100. I borrow the max LVR, 70%, which means I'm borrowing $70. I'm right on the threshold. Imagine that the share price drops by $1. Only one. The max LVR is 70%. The LVR on this particular loan is 70.7%. You have triggered a margin call just by going over the maximum LVR of 70%. That's how it works. Okay, I've triggered a margin call, but what exactly is a margin call? A margin call is triggered when you exceed your maximum LVR. A margin call forces you to return the LVR of the loan back to its maximum cap. Forces you to. That is the key here. So they don't write you a note and say, over the next couple of months, could you please return your LVR? No, it happens basically instantly. You are told in no uncertain terms that you have to fix this immediately, typically into 2 to 5 days. I've heard even within 24 hours. So, how do I resolve my margin call? There are two ways. You can either add more cash so that the amount that you're putting in is higher, bringing down the LVR overall, or you can sell some shares because you've still got the original same amount of cash. You now have reduced the loan overall, and one of those two ways will solve the problem for you. Well, that sounds scary. How do I prevent a margin call from occurring? Well, it's simple. Simple, you say? Tell me more. If you like to earn money, then you like to borrow as much as possible, obviously, because borrowing magnifies your returns. But if you go anywhere near the cap, the LVR maximum, even if the price varies a little bit, perhaps it dips, will trigger the LVR, the margin call. So ideally, you do not want to sell your shares into a falling market. So let's put aside that option. So either you have some safety money around, and a lot of people do, some bit of safety blanket for a rainy day. Maybe the share price dropping is that rainy day, or else simply don't go anywhere near your 70%. Maybe choose 50% or something that's a little bit safer for you. So when I buy my shares on margin, I have to be careful about the amount that I'm borrowing. But did you know that the shares are not your own? What? Not my own? I bought them. They're my shares. They're in my name. Well, no, they're not. If you're going through a margin account, technically those shares belong to the bank. They may have your name associated with it, but those shares are outright owned by the bank in reality. Listen to this. If you fail to meet your margin call, if you go above your LVR ratio, the bank sends you a message. Let's say it goes to your spam filter and you don't know anything about it. Too bad. The bank will force sell your shares. They can do this on you because the shares are in their name and they have that power to do it. How many of my shares will they sell? Well, they'll sell enough to bring the LVR ratio back to its maximum threshold. Well, are margin loans safe? Are they the best way of using leverage? But if I don't borrow against my shares, am I stunting my potential growth? Should I get a margin loan and meet the interest payments with dividends? Oh, that's an interesting idea. Too many questions. I am forced to make another video to answer all of these questions and many, many more. So make sure you subscribe so you won't miss out on that. The question you need to ask yourself is, if I'm going to borrow on margin, how much am I likely to make? What's the typical return on the share market? That's the first question I need to answer. Is it, say, 7%? Is it, say, 12%? I've done a video which answers that question specifically. You can click on that right here. Go ahead, it will answer it for you.